From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, June 11th, and you're listening to the Macrocast. Tony Prado here in New York, John Fagan, Brendan Walsh from Markets Policy Partners down in the DC area. Guys, we had our economic sentiment index come out this week with another decline in sentiment, below 50%, down to the 3-day rolling average around 48. It was, we were at a high in May. Since then we've seen some tapering off of the, maybe tapering off the housing market, definitely concerns about inflation. We've been talking about inflation on the Macrocast. I think we're gonna be talking about it for a good long while. And we had some news yesterday on it as well with CPI. What's your read on CPI, guys?
I think that when you look at the details of this report, it very much supports the Fed's idea that a lot of this massive increase in the overall and core rates is due to the reopening of an economy and both labor and supply constraints. Like the used cars were again up, almost 10%, which accounted for a third of the increase in both the headline and the core. That's going to go away eventually. Also, it seems
headline, Brendan, was what, about 5%, right?
Yeah, exactly. And also raising rates is not going to help the shortage of both new and used cars that we have. That actually would exacerbate it. But the even more important point is the Cleveland Fed does a median CPI where they take away the fat tails. So those components that were up, 10% are taken away. And that was running at 2.1%. It's just actually for the first time in months, it's hooking up slightly. So that very much supports the Fed case that it would be a policy error to look at these massive increases in a small amount of components and and start tightening policy. And right now the markets seem to be agreeing with that view.
It sure seems that way. I mean, if you had told me that we were going to print 5% headline inflation, 3.8% core inflation, even with all the caveats, and the 10-year would dive to 145, I'd say you're crazy, right?
Yeah.
It is a testament to how effectively the Fed has messaged this. It's really been unanimous. You can't find any Fed official that is really banging a drum about inflationary concerns. Even the hawks are saying that this is transitory. It has just been a unanimous chorus, and they started messaging this early and often, and it's really gotten through. And the data, as Brendan said, the data really backs it up. These are pretty obvious distortions. So the headline figure, while it makes good copy in the newspapers, and certainly politicians are using inflation as an argument against the Biden, on the GOP side of the aisle,
to argue against spending.
What's that?
To argue against spending.
Oh yeah, to argue against spending and to blame the Biden administration for it. I think that's something that that is going to continue, obviously, as long as these dynamics keep playing through. But the market.
But as an investor, if you can borrow at below 1.5% on something that everyone admits will have a positive return, both on the investment but also on society, it's very frustrating that we're not taking advantage of this for something that everyone agrees we really, really, really need.
The infrastructure, the infrastructure debate is definitely heating up, and I think that we got this in the equanimity of the longer duration Treasury market. There's debate. Is this really more of a trading dynamic? Is this basically shorts that were trying to bet on higher yields, getting caught off guard and capitulating? surely there's an element of that kind of trading dynamic that's playing out in the market.
Was so short and also so priced on the Jackson Hole meeting for the announcement that everybody just had to cover their shorts.
I think it's totally fair, and I wouldn't discount that playing a role certainly in the price action. But when you look at the overall trend, one of the things that you don't want to hang too much, at least in my experience, hang too much on the technical aspects of trading. The Treasury yield curve is not a segment of the market where you want to take its message lightly. And the flattening of the yield curve that we've seen right now, it's healthy. It's sort of a counter trend corrective. But if it continues, if the 10-year starts to decline from here, and we get another non-farm payroll number that's a little bit squishy, and next week's retail sales and industrial production for May comes out on the weak side, people are really going to start asking questions about whether we have, properly assessed the trajectory of this rebound. So, we're supposed to be worried about inflation. You're looking at the headlines, we're supposed to be worried about overheating and inflation fears. But the market there are flickers of concern about growth, whether it's Dow Transports, that's a very growth, leveraged part of the equity market, the Treasury yield curve. Look at Caterpillar, some of the stocks that are supposed to be benefiting from a big infrastructure push, those have rolled over. And so we've gotten outperformance from the big tech stocks again, which tend to benefit from a low growth, high liquidity kind of environment. So it's not, it's still a counter trend corrective kind of dynamic, but if it continues, the message is really going to be kind of a downbeat one on the growth side.
The one thing I think we can all agree that it is not, and despite what despite the if you watch local TV news when they do their stories, or seeing it on the internet and elsewhere, and the sort of hearkening back to what inflation was. This is where I've resisted, the okay boomer meme, right? Like there's a little bit of like okay boomer on this. Like this is not that. This, that was something very, very different, and it's not what we're seeing today. It's a very, very different. That was a policy mistake. But by the way, like one of the guys who did a lot of the research on the policy mistake of the great inflation of that, 1965 to 1980, 82 period or so was Rich Clarida. I was one of those guys. Some really good academic research on, missing the output gap and sort of this persistently being off on estimating productivity. He knows a thing or two, and he's sitting on the Fed board right now, and you can be sure he's looking out for that.
Yeah, and he's definitely not beating, the drum about worrisome inflation. He is he's right in there with the rest of the Fed officials talking about the transitory nature of this. Although, he's mentioning he is among the FOMC members who've talked about the potential over the coming meetings. Perhaps it might be time, if things continue to get better, to talking about the taper. But, this is what passes for a slightly hawkish commentary in an environment where the committee is very, very dovish and committed to accommodation, as optimistic as they are about the economic outlook. I think just back to inflation, one of the things that we encountered, certainly I was at the Treasury Department when we had a period of very high gasoline prices, very high oil prices. And that was seen, and commodity prices, high food prices, those were seen as deflationary, given the fact that they weren't feeding through into wages. It was basically taking, the spending power out of people's pockets in a way. And I think that is something that is probably very much in the Fed's thinking right now. They're not talking about it a lot. It is kind of wonky, and they don't want to be overplaying, this discussion about high commodity prices. But you can certainly make the case that higher oil prices, higher lumber prices, all the stuff is, it is ultimately sapping. It's not feeding through into necessarily higher wages. It's not a wage price spiral. And so that on its own can be actually deflationary over the medium term.
What are your views on housing right now, on where that's going? Because it seems to be, seeing some signs that, we're going to maybe get some froth out of housing here, but it seems really hard to tell because, obviously financing is there. It seems like, we had, such super strong demand, but at a certain point in time, on the one hand, maybe we've run out of houses, right? Which seems to, it's like, that's the car problem, right?
Yeah,
our problem
that is part of the problem.
Yeah, we can't make more cars because we don't have the chips for the cars. So we see 7.3% increase in used car prices. Get it? Easy. Houses, you can't build too many, houses as quickly as demand has rushed into it. But is it that, or is it, all the people who wanted to move out to the suburbs, move out of their apartments, have done it? We don't know.
Yeah.
And
now are they going to come back to the cities?
Well, yeah.
So you could actually have a little turnover there. I feel like this isn't really an economics issue. This is a psychological, sociological issue, Yeah. You just had people move so far away, and now we're going to find out if you can stay where you moved, or if your office is going to make you come back to the office.
Yeah, and the housing market. The basically, understanding the supply and demand dynamics and how fast home builders can respond to these, particularly at a time when right now it's the crews may be depleted because of the pandemic and other factors, but you also just have the fact that it's hard to source the materials and got a long backlog waiting. It's, I think this falls under the larger umbrella of the Washington, D.C. looking at the supply lines for various industries, various key industries. It's not just chips and housing, but other stuff as well, certainly medical, and the strategic supply lines and how those can be, shored up, protected. What can the government do to try to facilitate these coming back, and operating at full capacity, and in a, in the most strategic ones, in a very domestically oriented kind of way, that reshoring dynamic. It's, the pandemic has gotten the government back involved in the economy in really major ways. And, the name of our company, Markets Policy Partners, is kind of a giveaway. We think that this is a trend that the increasing alignment of public and private sector initiatives is going to be a major theme going forward.
Well, why don't we take a break and come back and talk about two of those themes that are ongoing this week. One has been maybe some movement on infrastructure and tax policy, and then global tax policy and some global economic stuff with the G7 getting underway today in Cornwall. Let's come back after this break. You're listening to the Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through hamiltonplacestrategies.com.
All right, back on the Macrocast. Guys, you were talking about the big footprint, John, that governments are having on the macro economy, but also on a lot of sectors. One of the big ways underway that'll have a big impact for some years to come in transportation, in energy, and potentially some other areas is this infrastructure package that's wending its way through the Hill, or I don't know if it's wending or if it's
trundling.
Yeah,
some would say still.
Yeah, listing, whatever it is. But there was I hate to call it a breakthrough because I don't know if it's really a breakthrough, but 10 senators, 5 Republicans and 5 Democrats last night yesterday agreed to a package. It's not worth getting too tightly into the details, but a bipartisan package. You got 10 Republican and Democrat senators. But as one senator commented on it, is like, you still need, you're still you got 10, you're still 50 votes shy, right? And you got 5 Republicans. And the only way to get those, to get 5 more Republicans is to lose those 5 Democrats.
Yeah.
So it's still really hard. But I think it's good. One way or another, whether it's a bipartisan package or reconciliation, we're going to see some significant spending over the next probably 5 to 8 years on infrastructure. That's a good thing. But it's going to be pretty ugly getting there, isn't it?
It sure seems like that. As you said, this bipartisan proposal, it's a constructive proposal. It's encouraging that they were able to find something that is, that has a meaningful. It's a meaningful and viable proposal. It still doesn't really get close. It has, the headline is 1.2 trillion over 8 years. All this is reported. It's not necessarily official. They've announced an agreement, but the details are still pretty foggy. I guess they're going to go out today with them. It's supposed to have about 580 billion in new spending. The Biden administration was closer to $1 trillion in new spending. And, importantly, it leaves out some of the elder care. It really focuses on physical infrastructure. The Biden administration and certainly the left part of the Democratic Party have been very outspoken about expanding the concept of infrastructure to things like elder care. It's an important part of, as you say, keeping the Democratic caucus on side. And this the makeup of this bill makes it challenging for them to accept without causing some problems on the left flank. And I think that is also the case when it comes to revenue raising. There have been some real crosstalk about revenue. The initial headline said that this proposal won't have new taxes. And then there are, subsequent reports that the group is considering indexing gasoline taxes to inflation. There's some talk about the miles driven tax for vehicles. Just don't think that the Biden administration is going to fall into that trap. They've come out and said, look, we're not raising taxes on people who are making less than $400,000 a year. Those taxes would fall on people, plenty of people. In fact, probably disproportionately on people making less. The truck drivers freaking out about it. It's not something that we think the Biden administration is likely to.
And I tell you, it's one of those things where roles have been flipped over the years, right? Because for years and years and years, environmental activists have pushed to raise the gas tax in order to push policy towards and to raise the price of fossil fuels so that alternative energy would become more competitive and encourage electronic vehicles, right? This was a major effort on the left, was to increase the gas tax. Everyone remembers Al Gore famous the BTU tax, and that's what this was about, to reduce the use of fossil fuel. And Republicans would argue, we shouldn't be raising taxes on working people. Now you have Republicans out there saying, why don't we just raise the gas tax? And Democrats are saying, this is raising taxes on poor people. So, policies are completely malleable in Washington if you stick around long enough.
I think that's right. One of the anomalies of the Biden administration that we've been advising our clients on, and this is even before they got into their seats, was what we predicted would be surprising overlap and continuity between the Biden administration and the Trump administration, obviously with radically different styles.
Yep.
And some major differences clearly around certain policies, particularly multilateralism. We'll talk about more about that in the context of G7. Yep. But when it comes to the focus on the working class, that manufacturing, build America, the countering China. We saw a bipartisan bill that that passed the Senate this week about U.S. industrial and tech policy, about beefing up U.S. manufacturing capabilities, strategic manufacturing capabilities, in an effort to counter China's ambitions. And this is like, that was, the Trump administration was a lot of things, but they changed you can say a lot of things about them, but one of the things you can say is they changed the narrative on this particular issue in a pretty fundamental way.
I want to come back to in just a minute. So make one last comment on this proposal last night, though. And again, this is like this, not this strange bedfellow, but this like some of this is communication, how you communicate these things, right? Because if the proponents of indexing the gas tax are very deliberately saying this is not a tax increase, this is strictly keeping pace with inflation, right? Which is like exactly the same argument for indexing the minimum wage, right? It's like, you're not increasing the minimum wage, you are keeping pace with inflation. And right, so there is an argument here, and I wish they'd called Hamilton Place Strategies before rolling out this idea, so we could have helped them with the messaging on it. It may have been, more, better received than it has been over the past 24 hours. And they allowed the Biden administration to come out with negative comments about it, which is, I think, a real mistake. Because once you've already said you don't like something in Washington, it's kind of hard to go back and say, well, no, I was wrong, I liked it. No one's ever wrong in Washington. Conditions have to change. Well, look, get into China, so this is, big G7 week, and, we're going to have a communique again. We haven't had a communique in a number of years.
Right.
And one of the themes of it, if I think about the G7, what it's about right now, and for the Biden administration, it really is about rebuilding we talk about the transatlantic relationship, but really because Japan's there too. So it's the allied Western-style democracies of the world's major economies, repairing those relationships so that we can get movement on things that are priorities for the Biden administration, like whether it's on climate or global tax policy. But also overriding, as you mentioned, is this, dealing with China. And, you get the sense that they feel like, 4 years have been wasted in terms of not the sentiment, you basically, good cop and bad cop maybe should be in the room together. It's we had just the bad cop for, 4 years. But he identified the right target in Trump in China. They want to deal with it linking arms with allies, not punching our allies in the face. And that's something that we've advocated for a long time, that, you want a united front on China. That seems to be where they're trying to go in Cornwall, isn't it?
Yeah, that's absolutely right. And the united approach in some ways is very favorable. It's something that the Chinese are obviously intent on dividing, pulling parts of Europe into whether it's 5G, whether it's some of the other places where we've got strategic competition. It's not an easy task necessarily. The West isn't as aligned as we might be on some of these issues, but I think the Biden administration is certainly committed to the multilateral approach. The question, I think one of the questions that's got to be on the mind of our allies is, well, what happens after 2024? We've got this multipolar moment back, but can we really count on it? And I think that's something that the Biden administration is probably messaging behind the scenes, which is help us. This is the more that we can work together, the more likely that we can get some successes on this, and the less likely it is that, the U.S. political situation crashes back and forth between, multipolar and unipolar and so forth. Let's make the multipolar more attractive by cooperating in a more feasible way. We saw earlier this week, U.S. and EU buried the hatchet over the tit for tat tariffs that had stemmed from the Airbus versus Boeing case those countervailing duties. Both sides have agreed to roll those back. That is good. So clearly they're trying to make hay while the sun shines and make, the big knock on the multipolar, that kind of approach and multilateralism that the Trump administration said was we always get shafted by our allies. I think that the message from the Biden administration quietly behind the scenes will be like, hey guys, you got to give us some wins here. Let's all win together. To keep the unipolar sentiment at bay.
Yeah. It's this is, do you think they did lose ground? Have there been things that are, that can be recovered here? I mean, if you think about, where we were, and I'm not putting this on the Trump administration. This is just, because really the fault here lies not with the people trying to fix China or to, nudge China in the right direction. The fault really lies with the Chinese. But if you think of where we are today versus where we were, 5 years ago and 10 years ago and 15 years ago, I'm going to put most of the blame on Xi. Not on Americans and Western nations here, but we are, we're seeing, genocide of significant Muslim community in China, the Uyghurs. No improvement, in fact, a deterioration with North Korea. No improvement, but a deterioration in the South China Sea. No improvement, but a severe deterioration in places like Hong Kong and Taiwan. The Belt and Road Initiative and certain commercial activities that hurt American companies. Not to mention being a source of things like harboring some of the cyber attacks and that we've seen. So China has not been a great actor, even if there are a lot of Chinese companies that have actually been really, really good companies and trying to do good things and trying to do them in the Western way. We're not, it's hard to see where improvement comes in those areas in a short period of time. And China seems to be digging in its heels in all of those areas.
That's right. Yeah, they've lashed out, and the Chinese government is, as you said, they're a malign actor on the world stage. They have taken, they've they've plotted this course out pretty clearly under Xi, and it's been pretty effective. The divide and
become more effective as they become a much larger economy too, right? I mean, this has always been the problem. It's easy to attack the American companies and the NBA or the movie industry and others who have to find a way to sell into what is now the world's largest market.
Right.
So they have to find a way. Otherwise, they are ceding the world's largest market to their other global competitors. So you can attack GE, the client of HPS. You can attack GE, but like Siemens is free to operate in there, or Mitsubishi is free to operate in there. You can attack GM for building its cars in, a lot of cars in China. But if, GM has to exit, Volkswagen is going to do more cars in China. And if Nike, has to stay out of China, does Adidas have to stay out of China? These are like this is the reality for, global corporations who are just, they're trying to make their stuff and sell it in the places. And China is forcing them to choose sides in global geopolitics. And, look, that's what they signed up for, right? I mean, so it's not a question whether it's fair or unfair. It's just what it is. But it's certainly challenging for these companies.
Yeah, and there's no question. And it certainly looks going to get worse before it gets better. There is the line of the trend line is not going the right direction. We've seen, obviously, the U.S. government and Chinese government, re-engaging on specific issues, but the tensions are obviously there. And when it comes to, the government's going to pick its spots, right? When it's things like, the strategic, the military usage, that sort of, bit by bit, beginning to deny the Chinese, military industrial complex pieces on the chessboard. And that is, they're not going to mandate, that U.S. companies can't do business there. That's just, but going to be that incremental bit by bit approach that makes it, it starts in certain industries and makes it harder. We saw the Biden administration roll back the executive orders banning TikTok and WeChat. Those are, let's face it, they're just some things that are too big to, you're not going to, no matter how bad their accounting is, you're probably not going to delist some of the biggest Chinese ADRs in the next few years when they're
another, Didi, listing today,
right.
A $10 billion, listing here in the United States. I mean, the integration is going to continue.
It's going to continue, but so the U.S. government and U.S. companies are just going to have to, there's certain areas that are just going to be far more challenged and a lot more, restricted than others. And those boundaries are going to expand, and it's.
I like the direction that Biden administration is going on this. I mean, look, I would love to see that, more. I would love to see the Biden administration do a lot more on trade liberalization. I would love to see them get back into TPP. It's still just such an enormous frustration. President Biden meeting with Prime Minister, Boris Johnson yesterday, and just the sheer irony that Boris Johnson, that is leaving one economic arrangement with Europe, but is considering application to the TPP, the thing that we created and that we are not now a part of, and not looking to join unless there's a change of heart in the Biden administration. But those are the kinds of things. I mean, at the very least, the linking of arms with allies to try to take on China is broadly the right strategy. All right, when I take a break and come back and take a look ahead to next week, you're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter at marketspolicy.
All right, back on the Macrocast. Got a big week next week, don't we?
On the data front, the retail sales, one of the top three most important data points that we get between inflation, jobs, and then retail sales. And also we'll be beyond the stimulus checks, which kind of distorted things. We spent a bunch and then we didn't spend it. So this will give us a good sense of, we had a month of reopening, and did people go out and spend money? And then the Fed has their interest rate meeting. We'll also get some projections.
The Fed. I think the Fed will be, definitely very, very interesting. I mean, we're getting to that point because of, because these guys, you cannot do a public appearance right now without having to talk about inflation.
Yeah.
I think, John's point earlier that they've actually done a pretty good job, right? I think, the market participants believe them. That it's transitory, and they're seeing some of the same evidence, and they seem to be coming to the same conclusion. People are not believing them. As we opened the show talking about the economic sentiment index, and I think part of that is fueled by concern over rising prices. They're not listening to Rich Clarida's talk and reading his, paper. And so they're just seeing, prices rising. And I think we're going to be stuck with this for a while. So I'm going to be paying close attention to how they continue to message on this and see if they can do a better job of, reaching out to, regular Americans and getting them to believe this as well.
I suppose we'll get some more negotiations on the infrastructure. It's kind of a big week, I suppose. Probably next week we'll find out whether the bipartisan bill has legs or it falls apart, right?
Yeah, look, they're still stuck in a hard place, right? There are no easy answers on this when you're 50-50 and you've got not one, but two or three members on either side who aren't regular votes for you. So, we still think they're going to get something in. It's going to be in reconciliation, and they're going to do enough to pick up a couple Republican votes, so that it's not just Manchin, but and Sinema, but it's a few, and it's going to be largely spending and largely unpaid for.
Yeah.
But we'll see, as you like you said, like we'll have a little bit more paint on the sketch when we talk again next week. Guys, have a fantastic weekend, and we'll catch you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.